Not all mortgage loans are created equal. Some can save you tens of thousands, while others only work in very specific situations. So today we're going to be ranking the most common mortgage loans on a tier list, from the absolute best all the way down to F, the ones that you should absolutely avoid. I'm Robert Weinberg, mortgage loan officer for over 20 years. I've seen every type of buyer, every type of loan, and now I'll show you where each really belongs. Let's first focus in on first-time home buyers. Here's the tier list. To start out, VA loans on the S tier, which stands for specialty. This loan is only for veterans and their spouses. The benefit of VA loan is zero down with no PMI and stellar interest rates. But VA loans are only for those who qualify. Specifically, you have to have military service or you need to be the spouse of a military member that was eligible. So if you want to know if you're eligible for VA, there's a specific item called a COE or Certificate of Eligibility, which we can then get for you as lenders to see if you're eligible for the VA loan. If you qualify, it's amazing. Now, the next loan we're going to discuss is the FHA loan, which stands for Federal Housing Administration. Now, for first-time home buyers, I'm going to grade the FHA loan an A. And the reason why FHA is an A is because it offers a super low down payment, only 3.5% down for single family all the way up to 4-unit homes. And FHA has one of the easiest credit qualifications of any loan program available. A lot of flexibility with the credit. But the downsides of FHA, let's talk about where it really can cost you a lot of money. FHA has a mortgage insurance premium requirement. Even if you put more than 20% down, you still have this mortgage insurance premium. There's an upfront premium and a monthly premium. And the upfront premium is equal to 1.75% of the loan amount as I'm recording this in 2025. That amount can be thousands of dollars added to your loan balance. So it's something you really want to be aware of that you won't have on a lot of these other loan program options. The other thing is the property standards. On FHA loans, there's going to be an appraisal done of the property that you're purchasing, and they do have minimum property standards that the property needs to meet in order for the home to be appraised as is and allow you to purchase it. If the property doesn't meet those minimum standards, then it's going to need to be fixed before you can close on your home and move forward with your purchase. So keep that in mind if you're looking to get an FHA loan on your new property. The next loan program that I want to discuss is conventional loans. Now, this can be either an A or a B tier. It's going to be more on the A tier if you've got strong credit and a low debt to income ratio. Many conventional programs will cap you around a 45 to 50% back-end debt ratio. Great thing about conventional loans is that if you meet the eligibility criteria, you can put as little as 3% down. And the PMI, it can be removed when you meet certain criteria on the loan and on the equity. There are also very flexible property standards. So if you're buying a property that is questionable for FHA, we want to look at it from a conventional standpoint and see if it may qualify for conventional. The next loan program I want to discuss for first-time buyers is going to be jumbo loans. And I'm going to grade this one a D for first-time buyers. And the reason why this is a D is because it only applies to very high loan amounts. In many areas, it's going to be if you're buying a home worth over $1 million or more, above the conforming loan limit, loan amount. So in many areas, that's going to be a loan amount over $807,000. Now, another reason why jumbo isn't ideal for first-time buyers, and I'm grading it a D, is because of the down payment requirements. Unlike other loans where you can put 3.5, or 5% down, with jumbo, you're looking at a minimum 10 to 20% down payment, depending on the property type. The other thing is that jumbo loans have very strict documentation requirements, your pay stubs, W-2s, bank statements, and all the bells and whistles, and jumbo programs have the most strict debt to income criteria of any loan program. So if you don't fit in the box, it's very easy to be denied for a jumbo loan. It's just not practical in many cases for a first-time home buyer to be getting into that $1 million type of property and that jumbo loan up front. It's just not practical for most first-time buyers and the average buyer to save 10 or 20% down for their first property. And the last loan that I want to mention here real quick while we're talking about first-time buyers is DSCR loans. You might have heard of these properties all over the internet. Now, this I'm gonna rate an F for first-time buyers because it's not meant for first-time buyers at all. A DSCR loan stands for debt service coverage ratio, and this is an investor-only product. So this isn't for a vacation home or your primary home. It doesn't even apply. You can't even get a loan if you're trying to get a primary through DSCR. It won't be approved. So for that reason, I graded an F. Now, switching gears over to talking about investors. If you're an investor and you're looking for the best type of mortgage, let's grade the investor tier list here. Now, first of all, at the top of the list is going to be the DSCR loan. We're going to put this in the S tier for specialty. This is designed for investors only. And one of the reasons that it's such a great option is because the approval is based on the property's cash flow. It's not based on your income, your taxes, how much you make at your job, how much you get from investments or any of that stuff. So for that reason, a lot of entrepreneurs, a lot of long-term investors choose the DSCR product because of minimal documentation. Understand that you're gonna need a minimum of 15 to 20% down to get a DSCR loan. Depending on the property type, you might even need a little more, but the minimum is 15 to 20% down. So realize that if you're an investor trying to just get in with a low down payment, like 3 or 5%, it's not gonna happen. You need to save more. But DSCR is the primary option when you're looking to scale your rental portfolio because there is no limit. We can get DSCR loans even if you have 10, 15, or 20 mortgages already on your credit report. The next loan I want to mention in regards to investors is going to be the conventional loan. I'm going to grade this one an A tier. Now, the reason why conventional loans are an A tier is similar to DSCR. You can get in with as little as 15 to 20% down. The interest rates on conventional loans are going to be very, very good. I would say comparable to a conventional when you're buying a home, just a little bit higher for the risk associated. And the last big advantage is the penalty. There is no prepayment penalty on a conventional investor loan. And that's gonna be a big contrast to DSCR, where there's almost always a penalty depending on your state to pay off early. A big limitation of conventional loans for investors is gonna be limited to 10 finance properties. So once you have 10 mortgages, you are now no longer going to be eligible for any sort of Fannie Mae, Freddie Mac conventional program. You're going to need to look at the alternatives, like we're saying DSCR, where there is no limit. So that is one of the biggest limitations why a lot of investors shy away from the conventional loans after a couple properties because of those limitations we're discussing. Now, the next loan I want to talk about in context of investment property is going to be the jumbo loan. And I'm going to give this one a C tier. Now, on the jumbo loan, it's really only going to apply if you're buying a property that's above the conforming loan limit, or a loan amount, I should say, above the conforming loan limit. So in most areas, this is going to be like an $850,000 to $900,000 home or more, depending on the type of property and the area. So for most real estate investors, that price range is going to be above where it makes sense to buy an investment property. It's going to be a little bit of a harder approval to get because these jumbo loans, unlike DSCR, these are going to require full income documentation, pay stubs, W-2s. We need to look at your tax returns for at least the last 1 to 2 years. So it's going to be a very thorough evaluation specifically on your income that's going to make it different from others. And this is why a lot of investors shy away from even looking at the jumbo programs. Now, FHA and VA is the next one I want to talk about in the context of investment property. And the truth is, these are just not applicable. We're going to give them an F tier for investors because FHA and VA, you cannot apply for if you're not going to live in the property. These are for primary residents only, not for investments or second homes. Now, let me quickly talk about the differences between conventional and DSCR loans when it comes to investments. They're both going to be great options, but the conventional is going to require the full income documentation, pay stubs, W-2s, tax returns. We need to fully document where all your income is going to come from, whereas DSCR, we're not looking at any of that. It's solely based on the rental income of the property. And the other big difference is the prepayment penalties. Conventional loans are generally not going to have any penalty, whereas DSCR loans are going to have anywhere from a 1 to 5 year prepayment penalty. The good news is that gets you a better, more competitive interest rate, but the bad news is that many investors, they don't realize they have these prepayment penalties. So they don't understand that if you pay the loan off early, either by refinancing or selling the property during that penalty period, it's going to cost you a significant amount of money. It's very important that you understand this up front before you actually sign on the dotted line and buy or finance the property. Okay, know your prepayment penalty options and rules. Where a loan lands on the tier list depends on your goals, first-time buyer or investor. Don't chase tier, pick what fits best for your particular situation. Some loans that look amazing at first glance, like FHA, can actually cost you thousands of dollars in the long run with mortgage insurance. And other types of loans like DSCR open doors you didn't even know you had if you're an investor. So that's the tier list, from VA loans at the top for veterans to DSCR loans, which are the king for real estate investors, and every single loan in between. If you want me to help build you out a personalized loan game plan, give me a call or hit the link in the description. And if you haven't seen it yet, check out my last video. If I were a first-time buyer with 40,000 saved, here's exactly what I do. It's a perfect guide for first-time buyers who want to make smart moves with their money.